the different phases of market as per Dow theory. Dow theory suggests the markets are made up of three distinct phases, which are self-repeating. These are called the accumulation phase, the markup phase, and the distribution phase. The accumulation phase usually occurs right after a steep sell-off in the market. The steep sell-off in the markets would have frustrated many market participants, losing hope of any uptrend in prices. The stock prices would have plummeted to rock-bottom valuations, but the buyers would still be hesitant to buy, fearing another sell-off. Hence the stock price languishes at low levels. This is when the smart money enters the market. Smart money is usually the institutional investors who invest in a long-term perspective. They invariably seek value investments which are available after a steep sell-off. Institutional investors start to acquire shares regularly, in large quantities over an extended period of time. This is what makes up an accumulation phase. This also means that the sellers trying to sell during the accumulation phase will easily find buyers, and therefore the prices do not decline further. Hence invariably, the accumulation phase marks the bottom of the markets. More often than not, this is how the support levels are created. Accumulation phase can last up to several months. Once the institutional investors absorb all the available stocks, short-term traders sense the support. This usually coincides with the improved business sentiment. These factors tend to take the stock price higher. This is called the markup phase. During the markup phase, the stock price rallies quickly and sharply. The most important feature of the markup phase is speed. Because the rally is quick, the public at large is left out of the rally. New investors are mesmerized by the return, and everyone from the analysts to the public sees higher levels ahead. Finally, when the stock price reaches new highs, everyone around would be talking about the stock market. The news reports turn optimistic, business environment suddenly appears vibrant, and everyone wants to invest in the markets. By and large, the public wants to get involved in the markets as there is a positive sentiment. This is when the distribution phase occurs. The judicious investors who got in early will start offloading their shares slowly. The public will absorb all the volumes offloaded by the institutional investors, thereby giving them the well-needed price support. The distribution phase has similar price properties as that of the accumulation phase. Whenever the prices attempt to go higher in the distribution phase, the smart money offloads their holdings. Over a period of time, this action repeats several times, and thus the resistance level is created. Finally, when the institutional investors completely sell off their holdings, there would no further support for prices. Hence, what follows after the distribution phase is a complete sell-off in the markets, also known as the markdown of prices. The sell-off in the market leaves the public in an utter state of frustration. Completing the circle, what follows the sell-off phase is a fresh round of accumulation phase, and the whole cycle repeats. It is believed that that entire cycle from the accumulation phase to the sell-off spans over a few years. So this is all about Dow theory.